Let's talk about you. Let's talk about me. Let's talk about you, you. Let's talk about me, me. Let's talk about la 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 la. Love is love. La 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 la. Love is love. Love is sweet tea. Love is a muppet. Love is boiled sweet stuck to your pockets. Love is a kiss when you least expect it to be. Love is wait on the corner, I'll see you at 3. La 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 la. Love is love. La 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 la. Love is love.
Welcome to the Singapore Property Show 2021 by MediaCorp and our partners 99 Group and top real estate agencies Propnex, ERA, Hattons, Orange Tea, and SRI. Now, for our last session today, we have David Bay, who is the CEO and co-founder of Mortgage Master. He will be sharing with us how he helped thousands of property investors save millions on their investments. Now, this is just a reminder before I hand the time to David. Don't forget to sign up for our lucky draw via the link below, and you may be one of the 2 lucky winners for a $100 cash prize at the end of this session. Now, David, I'll hand it over to you now. Do tell us what you have in store for us.
Thank you, Ning. Hi, my name is David, and of course, as already mentioned, today I'm going to share about how to save money through the financing of a mortgage and your property, and then how you can save a lot of money through that and not overspend or overpay things. All right. So first, a little bit about myself. I am the CEO and co-founder of Mortgage Master. I've done this for more than a decade. Started in 2009, so it's about for 30 years by now. I have actually been accredited as a subject matter expert by CNA, by the media. So they'll ask for codes to interview me when it comes to property financing, mortgage, or even property related questions. Personally, I've also done billions worth of loans at the same time. Now, the first thing that I want to tell everyone is, what does a mortgage broker do? Because this is what Mortgage Master does. All right. So interesting fact is that 80% of Singaporeans actually don't even know that a service like mine exists. So what do we do? First, of course, we advise on loan eligibility, how much loan you can take, what kind of interest rates there are. We also explain interest rates, the different types of risks involved, and which one is suited for you, because the lowest rate may be good for someone, but may not be good for another person who has other needs and wants. Excuse me. We also have all the interest rates from financial institutions at our fingertips. Means as of today, officially, there are 176 different loan packages available. What is good for you? Instead of you having to go from one bank to another to find out, and every single banker from the bank will tell you that their rates are the best rates, you come to us at Mortgage Master, and then we will tell you what we feel is the best rate for you based on the needs that you provide us, all right? Another question is, because our service is free, so people always ask us whether if they use our service, will they get lousier rates from the bank, because the banks pay us the commission, the referral fee. Well, the answer is, you don't have to worry. If you walk into a bank today and you take a rate from us today, it's going to be always either the same or even better, because we know what we can squeeze for you, right? So our service is free, and we are a one-stop shop that does everything for you. So it's actually a very good service that everybody should use, that is new purchase or even for refinancing. Now, today, the topics we are going to talk about are actually this. Firstly, I'm going to talk about the 3 simple questions that people have to answer in their financial matters before they invest in a property. Next, some clauses that banks provide that you actually sign up for that you don't know about, and I want to explain them to you, and also some clauses that you can request from the bank should you require. Some things that most of you may already know: fractional purchase, or what we call decoupling, and also what is 2M, 1B, 2 mortgager, 1 borrower. And also, of course, to understand interest rates. And by understanding interest rates, knowing what type of rate to get at that correct point of time. Because as the economy changes, interest rates rise and fall, you need to understand, based on your needs, your wants, or even your view of the market of interest rates, what rate is good at what time. Okay, so moving very quickly to the first topic we are going to talk about today is the 3 simple questions that you need to answer financially before investing in a property. Now, the first question is how much a person can borrow, and that's loan eligibility, all right? Traditionally, people in Singapore today always find a home before they find a loan, which is actually wrong. Because if you understand that you need to find a loan before you find a home, you do your maths correctly, your finances correctly, and then you purchase a property based on your limits, all right? So what are the limits? Of course, within your own financial means, because 15% of clients from the past decade that I've done, when they buy a new house and they reach me as a banker last time, or even at Mortgage Master today, we realize that these 15% of people do not have the ability to take a loan after they make a down payment. I am sure you have heard enough stories of people putting the down payment 1% or 1,000 for a HDB or even 25% for a new development, and they cannot get the loan after that, and there's a problem. They either lose their down payment, which is a lot of money, or they are forced to borrow from friends and relatives to finance this, or even take a personal loan to make sure that they can cover the rest of the down payment. And this is actually something that's very bad, and we want people to avoid it. So first, of course, please know exactly how much you can borrow, and then find a house within your financial means. Now, the second question that I'm going to talk about is actually very simple. Also, do you have the down payment available? So after you find how much you can borrow, it does not mean you have a down payment yet. Let me give you an example, all right? Okay, so let's say this gentleman right now, he from a normal $10,000 job, he suddenly got a huge promotion, huge pay increment, got headhunted. He earns 20,000 a month today. So his maximum loan is 2 million. Now, if he can take a maximum loan, he's very happy. He goes back, he tells his wife, let's go buy a nicer place to stay at and upgrade our standard of living, our house. Then he says, okay, I can take a 2 million loan. So I can go and look for a $2.6 million property. But you have to make sure that you have the 688,000 needed for both the down payment and stamp duties. And then if you have that also, do your personal preferences and your own wants in life, does it affect? Is it going to be affected? Because you may have savings for 688,000. Okay, if you don't have it, please buy a house that's smaller, upgrade to a smaller place, right? But even if you have it, do you want to wipe out all your savings and CPF to buy this? Are you comfortable with that? Everybody have different needs and wants. Please, again, find a house within your financial means. So the last question that I always ask my clients, the first two is very simple. It's pure maths, right? I have a formula. I can count how much you can borrow. Number two, we also know how much down payment you have based on the CPF, cash, and savings. And so people always ignore these last questions. I qualify for question one and question two, then I'll go and buy a place. Actually, the third question, in my opinion, is the most important. Why? Because how much you pay on your monthly installments actually determines your standard of living and your lifestyle. If that gentleman bought that $2.6 million house and his installments per month is at $8,000, even earning 20,000 a month may be comfortable for some people, may not be comfortable for people, because everybody's lifestyle is different. You may want to give your parents more money. You may want to, you may be a petrol head. You want to buy nicer cars and you upgrade from a Toyota all the way to a Maserati, and then your installments per month on the Maserati is 4,000. You may actually love to, YOLO, treat yourself to holidays, restaurants, no holidays these days, but restaurants and way of living. You may even want to be the kind that save more money. I earn 20K a month. Some people are okay not saving. Some people are okay saving 5,000. Some people want to save 10,000. So everybody's lifestyle is different. Understanding the amount of money you have to pay every month and being comfortable with that is actually the most important, because at the end of the day, you don't want to buy a house, have the down payment, and then suffer through your standard of living. It decreases dramatically. You don't want to buy your dream home and live like a pauper. Life isn't worth living like that most of the time, is it? So please always find a house within your financial and personal means. In summary, the three questions are how much you can borrow, whether you have the down payment, and of course, whether you're comfortable with the monthly installments. Okay, so the first topic is over. Now I'm going to go over to the second topic. It's actually more interesting. So as we move on, the topics actually get deeper and deeper and more technical. So the first one is actually very simple, right? But understanding these three questions is actually very important, and being able to answer them before you buy a house is the most important. Now, the second thing we talk about are bank clauses. So firstly, clauses that banks put into the contracts, okay? Cancellation fees. What is a cancellation fee? A cancellation fee is a fee that if your house has not been, your housing loan has not been dispersed, then you want to pay off the housing loan or refinance to another bank, it is cancelled. So I'll give you an example. If today I ask my best friend to lend me $10 in two installments, $5 and $5. After I borrow the first $5, the second one, and suddenly my pay come in, I tell my friend, hey, don't need to borrow the $5 anymore. My friend will say, hey, I reserved the $5 for you, okay? You got to pay me cancellation fee because there was a cost of funds involved. That is what cancellation fee is. If you don't use, you have to pay. So in what scenarios is cancellation fee, when does it happen to turn up? If you buy a new development, all right? And then at TOP, which is a time when some people may want to sell the new house. If you sell then, right, actually there's 15% of your loan that has not been disbursed until CSC. And this 15% will incur a cancellation fee. So for example, if you buy a $2 million new development, 15% of your loan at TOP that's not yet disbursed is $300,000. And the cancellation fee is either 0.75 to 1.5%, which will be at least $2,000 plus to $4,500. To avoid them, you need to, if this house is not for staying, then maybe you want to find a bank with a clause that allows you to waive off cancellation fees at that point of sale if you know that you may sell at TOP. Okay, so the second thing would be on penalties on so cancellation fee is penalties on undisbursed loans. Okay, so the next thing is that also, if you are going to buy another property, you may want to waive, you can actually get this to avoid this, all right? So if I sell property A to buy property B, and the bank wants to charge me cancellation fee or any penalties on property A, and you cannot escape because it's black and white, right? You can actually tell the bank, look, I pay you first, I will buy property B after I sell my first property, right? And if I get the loan from you again, can I get a refund of what I've paid? Now, these things all can be negotiated, but most people don't know, and that's why at Mortgage Master, we will tell you this exists, and then we will help you tell the banks on your behalf, because you also won't know how to tell the banks, right? So we will tell them for you. Okay. Another clause that the banks add in that the most people don't know is something called rate review dates. So what are rate review dates? You know, we use terms like 3 months SIBOR, 30 days SORA, 90 days SORA, which is also 3 months SORA. So what is this SORA and SIBOR? Let me use SIBOR for example, because we have used that for the past decade, although it's going to be gone in the near future. Okay, if you take a loan from a bank on, let's say today, the 20th of May, and you take 3 months SIBOR, we will take today's 3 months SIBOR on 20th of May, and SIBOR fluctuates like the stock market every day up and down. But I ignore the fluctuation from May to June, June to July, July to August. Until 19th of August, I will still use 20th of May SIBOR, and only on the 20th of August, then I take the new SIBOR for the next 3 months. Okay, so this is what 3 months SIBOR means. Now, if you sell your house and you have to complete the loan before the 20th of August, then your SIBOR, which is locked in for 3 months, is broken. And then you are breaking the rate review date. You have to pay a 1.5% penalty on the total loan amount. If your loan amount is $1 million, you pay $15,000 for nothing. Okay? So when you're going to sell a house, please make sure you know the rate review date. Then you negotiate with the buyer, right? I want to complete my sale on the rate review date so that you will not have these $15,000 loss for no reason. Okay? So don't even miss these dates by 1 day because you will suffer a 1.5% penalty on the outstanding amount. Understanding the completion dates, as I mentioned, is very important to avoid unnecessary costs. Because once you've already sold, signed contract already, you cannot go back on your word. Or the seller now, the buyer now has the power to tell you, no, I don't want. Then how? Then they tell you, oh, you are penalty 15,000, right? How about you give me $5,000 discount? You have no choice. Understanding the dates before puts you in the power to negotiate what is good for you. Now, what about other clauses that you can ask? As mentioned, you can get waivers of penalty due to sale added in today already when you sign the new loan. You can ask them, if you know you're going to sell the house in the next 3 years, 5 years, when you refinance, you can actually say, I want a waiver of penalty due to sale. You may not get it, but you can always ask. And if this bank doesn't give, I will find another bank for you that has this waiver of penalty due to sale. All right? Please always plan ahead when you refinance your loans or when you take a loan, understanding what you intend to do in the future. Don't just think of the now, think of the planning of the future, because that's where it's important. And that's where Mortgage Master comes in to help you with the financial planning. Some people want to pay down the loan during the loan period. There are actually packages that exist. You know, although interest rates are very low, we in Asian culture prefer to sometimes don't even have a loan and want to pay your loan faster. Some people are privileged. They have huge bonuses every year, and they can then use those money to pay down the loan every time they get a bonus. You can always pay lump sum to avoid the higher interest rates as well. In case interest rates jump from today very low to maybe, just 2 years ago, it was 2.5%, then you can also take and pay down the loan as and when you want. So if you have that ideation, you want to pay down the loan, And please also add in this ability to off prepayment in the loan package during the lock-in period. Okay, so we are done with the first two topics. Now we have the fractional purchase. If you have any questions, right, please ask, and then at the end of the whole presentation, I will actually address your questions as well. So fractional purchase, what are these? To understand these two terms, decoupling, fractional purchase, the same thing, and two mortgager, one borrower, first we have to understand the laws behind this that causes people to want to activate these things. So first, the law. We know that when we have to buy a house today, we have to pay buyer's stamp duties. We cannot escape from that. It's one of the things in life that you can't escape from. It's called tax. So buyer's stamp duties is very simple. The first 180K, you pay 1%. If your house is worth more than 100K, the next portion is 2%, and it's tiered basis all the way to 4% above 1 million. So for example, a $1.5 million house will have to pay $44,600 in normal stamp duties. A $900,000 house will have to pay $21,600 in stamp duties. Okay, there is a simpler way to calculate this, and this is the formula. So if you need anything, this will be the formula to take the shortcuts. If your house is less than 1 million, it's the bottom one, and it's more than 1 million, it's the top formula. All right. So buyer's stamp duties is not what we are bothered with. It's the additional buyer's stamp duties that we are bothered with. So through many iterations over the years, in 2012, 2015, 2018, the government has consistently changed the ABSD amounts. So today, this is what it is. If your first property, you're a Singapore citizen, you pay 0% buyer's stamp duties. If it's your second property, 12%, and then 15%. Of course, if you're a permanent resident, you've got to pay 5% if your first property, and if you're a foreigner, 20% upfront. So as you can see, this law protects the Singaporeans and the permanent residents more, and kind of puts it a lot more additional tax on the foreigners. Okay, so how do you avoid it? So if today you are a couple, you are a family, and you have already one property, so let's just call this couple Mr. and Mrs. J. They are 40 years old today. They are very fortunate. Both of them earn a high salary of $15,000 each, and they have no liabilities to allow calculation to be easier. They already own a $1.5 million property with an $800,000 mortgage. Today, they want to buy a next house, also $1.5 million house, because for investment purposes, right? The ABSD is 12%, which is 180K. But they want to avoid the ABSD, right? So what is going to happen? They want ABSD to be zero. They do what we call fractional purchase or decoupling. So what happens in decoupling technically? Okay, so first, Mr. J, or okay, let's say the husband buys the wife's share of the property. And when the husband buys the wife's share of the property, he buys 50% because today the property is owned by both names. So he buys 50%, he pays normal stamp duties because it's still his first house, right? On that BSD only of buying half of the first property. Look where my mouse is. And then he has to pay lawyer fees and valuation fees. It's a bit more expensive compared to normal. So it's around the range of $5,500 to $6,500. You've got to pay the seller lawyer fee and the buyer lawyer fee. The total cost is $23,600. But by paying this $23,600, now the wife has no house under her name, and therefore she don't have to pay the 180K ABSD anymore. So what happens next? She just buys the next house upfront herself with a loan. Make sure you count your loan repayment, your monthly installments, all comfortable, as in the first three questions just now, and then you get to save $156,400. So decoupling and fractional purchase actually is something that is very useful, as long as the couple in question is has the ability, has the money and the salary and the level of financial comfort to purchase. This actually is allowed and is totally legal. I know most of you already probably know what decoupling is because it's a term that has been widely used in the past 8 years since ABSD has been introduced. But this is technically what happens, and this is why people do it most of the time when they are financially comfortable. Okay, so now we go on to the next thing, 2M1B. What does 2M1B help with? There are two laws. One law that the government provided is called additional buyer's stamp duty. That is about the number of houses you own. The next law that the government actually implemented is the law on LTV, which is how many loans you have. Different. One is how many houses you own, one is how many loans you have, right? So We know that today, if you buy your first property, you can take a 75% maximum loan, okay, based on your loan tenor and your age, right? But then we also know that if when you do that, when you buy your second property, it's a 45% loan only. What does this mean for people? Okay, so now we look at the same couple. Everybody has different needs and wants in life. So some family dynamics, they don't mind, okay, the husband take one house or the wife take one house. Some family dynamics is, no, I don't want my husband or my wife to take one house by herself. They want the loan smaller. I want to have both houses together. I'm willing to pay the ABSD. Okay, if you're willing to pay the ABSD, then now you want to buy the second house, what happens? What is your problem? You only can take a 45% loan. If you buy a $1.5 million property, that means your cash needed for down payment is $825,000. Now, for wealth accumulation, right, to buy the next property to invest in, you want to do it faster to accelerate wealth accumulation should all things align and your property capital appreciation increase, or even with just rental yield. And having to save $825,000 to buy your next property while paying the original house mortgage is going to be a very painful process. So how do you buy a second property faster? You can do something called two mortgager, one borrower, which then allows you to have down payment. You take a full 75% loan and the down payment is only $375K. So what does this two mortgager, one borrower mean? So again, they are going to pay ABSD on the second house, but then see, both their incomes are high. When you refinance or you restructure your loan, you say, hey, only my husband is the borrower, but me and my wife both are owners. I'm the only borrower. So now your wife still owns property A, but her name is not in the loan. Credit bureau, she has no loan. In the eyes of the law, she has no loan. So now when both of you go and buy the second property, you put the second property loan under your wife's name only. She can borrow 75% because it's her first loan. I remember ABSD law is about how many properties you own, but the loan to value law is about how many loans you have. So now Mrs. J is available to take a 75% loan because it's her first loan. The first house, the loan is under the husband. And this means that she can take a full 75% loan. And as a finance person, again, I want to remind you, make sure that when you take a 75% loan and the installments is, let's say this much, 4,600, is very, very well within your means and your comfort level financially. So, in a nutshell, decoupling helps you save ABSD. There are some families who don't want to save ABSD because of family dynamics, and it's normal. Then at least you can use two mortgager, one borrower to accelerate and buy the second house faster, with both husband and wife names both in the second house as well. Okay, so this is totally explaining what fractional purchase is in technical terms, and also two mortgager, one borrower. Now, as I mentioned, we are going more and more deeper into the mortgage, right? So we have talked about how to buy more houses, how to get the banks to give you better clauses, or understanding even what you are signing so that you know what clauses are affecting you today. The next thing that we are going to talk about, and it's going to be even deeper, are about interest rates. Again, when you sign for a bank loan, interest rates make a big difference, especially when it comes to your cash flow and for investment property. If you are making an investment property and your rental yield is 2.5%, 3%, you don't want your interest rates to be 2.5% when you can get 1.5% and save 1% a year on returns, correct? And this is why you have to understand interest rates before you make the decision. And this is the job of Mortgage Master. We will actually help you understand it. Every customer that comes to us, we will run through the understanding of interest rates. But today, I'm just going to explain everything to you guys in summary. So, first thing we have to understand is during an increased economic boom, interest rates increase, and during an economic recession, interest rates decrease. So, for example, we talk about the two recession cycles and recession cycles. In 2008, interest rates was about 4.5%. By 2009, it's 2%. By 2012, it was 1.6%. We talk about this economic cycle. In 2015, 2016, interest rates about 1.6 to 1.8%. In 2019, 2.6%. Today, 1.2. So In 2019 was the boom. 2020, COVID-19 happened. So the things fell and interest rates fall during an economic recession. So there are many interest rates in this world, in Singapore, but mainly we will explain it in two portions: fixed rates and floating rates. What are fixed rates? Fixed rates are very simple. In the 3 years fixed, 2 years fixed, 5 years fixed, your rate will be fixed for whatever the banks promise you. Traditionally, fixed rates are higher than floating rates because you pay a premium. You pay a premium for the privilege of having your rates fixed for you, for the security of it. So that's why fixed rates are today about 1.15% to 1.68%, depending on loan size. Of course, banks give you lower rates when your loan size is $5 million, right? But of course, if your loan is 200,000, you will have to take the 1.68%. But if you notice, if your loan is 200,000 and it's a HDB, 1.68 is lower than the HDB rate of 2.6. Okay, so fixed rates are so good. Why do you have to know floating rates, even if you say I only want fixed rates? Because understanding floating rates actually is what saves you money. Every fixed rate after the 2, 3, 4, 5 years fixed will always go to a floating rate. Always take note what floating rate it goes to, because that floating rate will determine whether you overpay or not in the future. Okay? So a few floating rates I'm going to tell and explain today. SIBOR. SIBOR rates today, interest rates will be about 1.1 to 1.3%. Okay? The risk is higher, but it's transparent. It's actually due to market forces. In 2013, and it's still used today, the banks actually introduced what we call a fixed deposit link rate, where the rate is directly linked to the fixed deposit rates of the bank that the bank uses for consumers who put fixed deposits. Now, this is technically transparent because the banks, when they raise and drop it, right, it also affects their customers who put fixed deposits, and the risk was supposed to be lower. However, over time, we realized that the banks manipulate the fixed deposit rates, affecting mortgage and make it stay high, where the fixed deposit rates not directly linked to the mortgage fluctuate correctly. And so actually right now, fixed deposit link rates are not the flavor of the month anymore. Nobody wants to take fixed deposit rates because we find that the banks manipulate it. And then when the banks have control, it becomes less transparent. We also have what we call board rates. Now, I'm going to say this in a broad stroke. Of course, there are times when you should take a board rate, but a board rate is even worse than a fixed deposit link rate. The banks control it. You don't know what the rate is linked to, and you do not take anything that you don't know what is linked to. So there has been horror stories where people take a board rate and very quickly in 3 months down the road, suddenly the board rate increased by 1%. Why? Don't know. The bank just said, it's time to increase it. It's not linked to anything. And that's why we actually don't tell people to take a board rate most of the time. There are certain times when you take a board rate, it's actually because of the clauses that the banks put behind the board rate, which is beneficial to you. So the clauses make you take this rate, not the rate itself. Okay? And lastly, we want to talk about SORA. So what is SORA and why is it the new top of the town? So SORA is a rate that is very similar to SIBOR, which is highly volatile, okay, which is transparent because it's due to market forces. But when it's highly volatile, you also have high risk, okay? So what is SIBOR first? Let me explain. SIBOR stands for SIBOR, Singapore Interbank Offered Rate. It's a rate which banks use to lend and borrow money to each other. When you have a rate that the banks have to use to lend money to each other, you know it's transparent because banks will not and cannot cheat each other. Banks cannot cheat banks, there's no point. And so therefore it is due to market forces. When I want to borrow, like why does a bank need to borrow money? For example, Citibank, they do 100 million of loans today. However, unfortunately for Citibank, this is not their main country. They do not have $100 million in cash to disperse for the loans. So what happens then? Citibank will then ask the 3 big banks of Singapore, the local banks, DBS, UOB, OCBC, with all your salaries moving there, right? So they have a lot of cash. Lend me some money for the next 3 months while I prepare the money to come in. Then DBS will charge them 3 months SIBOR, right? So when interest rates globally rise, Citibank has a choice to either borrow from DBS or borrow from their own country, US. So if US interest rates rise, Citibank will say, I will borrow from Singapore. But SIBOR will also increase because it's a business. There's no point in DBS keeping SIBOR low where US interest rates rise. So they will still increase SIBOR. And that's why SIBOR moves up and down based on global economy. And that's also why SIBOR exists, for banks to lend and borrow money from each other. So it's transparent, right? You can't control it. You can't control, no one can control it. It's based on market forces. So what is SORA? SORA is literally almost the same as SIBOR, except instead of interbank, it's just Singapore overnight lending rate. Okay, so what is this overnight lending rate? So we don't talk about banks now, we talk about financial institutions, okay? It's an analogy, it's not the exact example that is correct, but for example, but I'll give you a scenario. So today we use some software to brokerage software to buy stocks overnight. I buy some currency with 20 times leverage, 30 times leverage, margin call and all that. When you leverage, right, where does the extra money come from? Who is providing that money for you to go and buy this stock, share, or currency with a leverage? A financial institution behind. And they will charge what we call an overnight lending rate because it's overnight, because US market is open when Singapore market is closed. And this rate, again, is fueled by supply and demand. It's fair. And when this supply and demand happens, then the rate will move up and down depending on the global interest rates again. So what is the difference between SIBOR and SORA? From the layman technical point of view, no difference. Why? Because the graphs move almost parallel to each other. It means SIBOR increased by that much, SORA also increased by this much. And because the graphs are very, very similar, is there much difference? No. So what you care about today, if you take a SORA rate versus a SIBOR rate, it will be about the spread and the absolute number after SORA plus that rate, what number it is. And that's where there's a difference. So if today you ask me whether you take SORA or SIBOR, I'll tell you what is the number behind it. Like SORA plus 0.98 is 1.15, but SIBOR plus SIBOR plus 0.7 is 1.14, or then to me no difference. But however, due to MAS having announced that SIBOR should be removed from the whole system in the near future, I would then advise you to take SORA, because once SIBOR is removed, the bank then reserves the right to move you into any rate they want, and they probably will move you into what we call a bond rate that I already mentioned you should take. So, understanding all these interest rates, how does that help you save money? This is where it gets interesting. It's about saving money because you need to understand when to get the best rate for the right time. And it gets more and more technical here. Okay, so I'm going to redo what I mentioned from the start. Economy boom, interest rates rise, and economic recession, interest rates drop. What does this mean? It means sometimes you take fixed rates are good for you, sometimes you take floating rates which are good for you. And so to understand this, we know that for the past 10 years, interest rates actually average around 1.6 to 1.8%. Today, like I mentioned, is 1.15 to 1.6%. So you may think that it's better today, but you have to understand first what it is normally. Then you have an understanding of what to take today. Now, loans have lock-in periods. You may not be always in the correct time when your lock-in ends or when you buy a house to pick the correct rate at the right time. However, most people can be able to arrange their schedules of loan refinancing schedules, the review date schedules, so that you can do it. And that is why even when you take a fixed rate, it's very important to know the floating rate after that, because you want to be in a floating rate that you may have to wait for maybe 6 months to 1 year to get into a better rate after that. And so you must know what floating rate you are taking also. Okay, so to understand better, let's look at some specific case studies and go back in time. Okay, let's look at what happened many years ago. And after I run you through this history, then perhaps you will get a better understanding of what rates to choose in the next today all the way to 10 years from today. You will have a better understanding of what rates to choose. All right. So, firstly, we go back in time to 2012. 2012 was the last market high. If you took a 800K loan amount, SIBOR was only 0.48% then. Fixed rates was like this. Okay, and SIBOR rates were like this. I use SIBOR because I cannot use SORA to tell you history. SORA was not used at that point of time. So, 3-month SIBOR, the spread, understand the things I want you to take a note of is this, the spread of 0.9, not what SIBOR is. Okay, so the spread is 0.9, fixed rate is 1.58. At this point of time, if you had taken a floating rate, you would be paying 0.2% lower than the fixed rate, and you may actually enjoy it better because by 3 years from then, SIBOR increased by a little bit, But at that point of time, you can refinance and you would already have saved 2 to 3 years of low floating rates. And at that point of time, you would then maybe still take a SIBOR rate or a fixed rate. So as SIBOR increases, the spread decreases to allow the floating rate to be around market trend. So why in 2012 it was lower than in 2015? 2015 is the norm. 2012 is quite close to the 2010 cycle. And in 2012, if you realize, actually the market had what we call a small technical recession where stocks and shares actually dropped for a little while. Okay, so we move on to the year 2018. In 2018, SIBOR was a lot higher already. Economic boom. Fixed rates is at 1.9. Floating rates, the spread dropped at 0.58. But floating rate spread is higher. So it was actually an anomaly, a time where it's weird, where fixed rates were lower than floating rates. Now, you probably will take a 3-year fixed rate of 1.9 if you had to take a loan at that point of time, correct? 1 year later, the economy really peaked, okay, 2019. SIBOR 2%, all right? Fixed rates, 3 years fixed, 2.45, SIBOR 2.25. Now, at this point of time, when I was working, people actually were choosing, they were wondering, should I take SIBOR or fixed? And they actually chose fixed because SIBOR, they are afraid that it will continue rising. Sounds familiar like the property market today, right? You buy because you're afraid it continues to rise. We don't know the future. It may continue rising, it may not. Was 2019 the peak or was 2020 the peak? Well, we know now on hindsight that 2020 COVID-19 happened, the pandemic happened, so SIBOR dropped significantly. In 2019, right, very interestingly enough, 80% of the people who took advice from Mortgage Master, we actually told them that we feel that the recession is coming. It is your choice to take, but we feel that SIBOR will drop significantly. So what happened? SIBOR today is 0.44%. Today, interest rates are like that for an $800,000 loan. Okay? So 1.14 versus 1.2. Will you take fixed or SIBOR today? Again, it's a question that you have to decide based on your knowledge of the market. Will SIBOR increase significantly in the near future? If not, if it does not, is 0.6% difference between fixed and floating worth saving today? You are not sure? We will then advise you and give you all the information provided to make the correct decision, or at least the more educated decision, not anyhow tikam then choose. Okay? So, in summary, and this is where everything is clear because I actually labeled it like that. Okay, so we look at all the interest rates there. If you had taken in 2012, today your interest rate is 1.69%. Not too bad actually, but compared to what we can get today of 1.2, it's actually nausea. But you wouldn't have lasted your 2012 to today, like you probably refinanced by then, right? In 2015, around the same, because you will have a thereafter rate of plus 1.25. In 2018, plus 0.85 because SIBOR was higher already, right? So the spread provided is lower. You're actually, if you're in this interest rate today, you will not refinance. But would you have dared to take SIBOR rate in 2018? Would you have even dared to take SIBOR rate in 2019? In 2019, the spread plus 0.25. Today, people are paying 0.69%. In fact, I have some clients and even some friends who heeded the advice to take SIBOR and of course take the risk that SIBOR will drop quite soon, all right? They are even paying less than 0.5% because they took 1 month SIBOR plus 0.1. And today, you have 1.14. Now, the understanding is actually very important. Do you think that interest rates rise or fall? Well, you see, this is after a recession. This is during a recession. Okay, so this is what happens. If you think today, what do you make a choice? What choice do you make? Today, would you actually choose to take, the fixed or the floating? To me, both are okay to be taken. But do you want to take the risk that SIBOR may fluctuate upwards, although it's highly unlikely? Highly unlikely doesn't mean not never happen, huh? Or do you want to take a 1.2% 3 years fixed? Because the difference between this fixed and this floating is so minute. A conservative person may choose the fixed. A person who just wants to save money and take the slight risk may take the floating. So really, everything that I'm talking about today is actually important to understand so you can make the right decisions at that point of time. Okay, so again, how do you choose the best interest rates? This is a summarized thing. Firstly, you must understand all the interest rates available. We also must understand the market trends. When the economy rises, interest rates rise. When the economy falls, interest rates fall. You must also understand your own personal risk appetite. If you understand all these three things, then you will make a decision which you will at least be happy with. And you also make a decision. And when things turn out, whether it's better or lousier, you at least went into it with open eyes and understand what you got yourself into. And when you sign the loan contract with the bank, you know that it's actually what you chose correctly, not something that people tell you this is good, just take. Right? Understanding is actually key. So at the end of the day, how do you save the right amount of money for interest rates? We talk about refinancing. Okay, so majority of people, as you see, that took the loan before in 2018, the range of interest rates they are at now is at 2.35%. Interest rates have only 3-year lock-in period. So today they can get out of the lock-in period, and refinancing can save them a significant amount of money. And this is where most of my job comes into place. How do we save people money, and how much money are we talking about? So in a 20-year loan, if you refinance, if you stay today at 2%, you are paying this much. If you refinance to a loan at 1.2% today, over the next 2 years, you will actually save $8,000. Is it worth saving? I actually think so. So you take the difference with $300, right? Times 12 months, 3,006 times 2 years, 8,000 more. Okay, even for a HDB, 300K loan. Yeah, my loan very small, I don't need to care about it. Well, that's wrong, because if you refinance, you still save 2,000 over 2 years. In this time of uncertainty in the economy, perhaps it is better to save money rather than not save money. All right. So things to consider when you are refinancing is about your current interest rate versus the refinancing rate, how much you save. Whether you want to extend the loan tenor because it is possible to make your monthly cash flow better, or to even lessen your loan tenor if you are doing better compared to a few years ago, to make your interest payment over the long period of time better. Of course, choose your correct interest rate type as well, and understand the risk level and the type of risk involved. So at the end of the day, it's not just interest rates that matter. The lowest rate may not be the best rate for you. It's about understanding and having the objective data to make the right decision. Okay, so when you refinance a HDB above 300K or a private above 500K, we also will cover most costs for you. So please do understand how to save money. Thank you. Things to consider are the fees, which I mentioned. If your loan amounts are above higher than 300K for HDB, or private 500K will be covered for you as well. All right. Thank you. So I'm going to give the time back to Ning Pei, and then I will also answer some of the questions which you all have provided also.
All right. Thank you so much, David. Such an insightful session. I'm certain we've all learned so much from it. David, are there any questions that you'd like to answer?
Give me a moment. I have to take a look at the questions.
All right, so quick reminder, everyone. I hope you all have signed up for the lucky draw. I think the link is now closed. Should we just bring up our lucky wheel to see who our lucky winners, our lucky winners, who they are?
Okay. Are you going to bring out the wheel, or should I answer the questions first?